All right, well, welcome back to the iWealth podcast, and today we're talking about Q4, which was it's pretty brutal.
Mm-hmm.
What was the consensus on that?
Yeah, I'll try to wear glasses today so that I look smart, Matt. But really difficult year, and you look at those statements; they'll be coming soon if they haven't showed up yet, and they're gonna be tough. But we hit the highs back in January, and so here we are a year later, and it just kept going down. Fourth quarter wasn't bad, but overall the returns, the S&P 500 was down 18%. That's 500 large company United States stocks. Yep. Some of them do business overseas, but USA stocks down 18. NASDAQ, which is technology stocks, down 32%. But the biggest issue is bonds. Bonds are your safe investments, supposedly, and historically have been. But we had a bond market that we haven't seen since 1976. So it felt different. Some of the people listening to this probably weren't even born back in 1976. Yeah, there you go. But, we were down 13% in the Barclays Aggregate Bond Index. 13% is big for bonds being down. That's supposed to kind of be safe. We do think we'll talk about 2023, and we think things will get a little bit better there and stabilize, and we'll talk about that. But then to kind of round this thing up, so -6 in municipal bonds. So state of Minnesota, we tend to pay our bills around here, so we don't really have a lot of defaults when it comes to bonds. Mm-hmm. But those bonds were still down, and it was all based upon the Fed, which we'll talk about. Best asset class, commodities.
Really?
If you're a farmer and you had corn and soybeans and those type of things, pretty good year. But commodities were up 16%. Cash was up 1.5%. Everything else was down, Matt. You looked at all the different sectors and things, so there's really no place to hide. We don't sell crypto, but crypto got crushed as well, as you know, if you're Bitcoin and things like that. So it just overall was a really tough year. However, I've never thought once this year, like back in 08 and 09, like it felt different, where we thought banks were going to blow up and weren't going to be around, and mortgage lenders and things like that. This doesn't feel different. And when we take a look at why this happened, it's the Fed, it's the Fed, it's the Fed. The Fed kept on talking about transitory inflation, meaning temporary inflation, and they probably wish they didn't use that term, but it wasn't temporary. It was here. Yep. A lot of the inflation number is based upon rents, and it's a backwards kind of looking indicator. And so when we look at 2023, again, it's the Fed, the Fed, the Fed. We believe that there's probably going to be some increases by the Fed in the first half of next year, probably in the first quarter, and then they'll probably take a pause. When the Fed finally takes a pause, at some point, we'll see this market kind of turn around. So we think it's going to be choppy and a little bit sideways in 2023. Sure. The two economists that we follow the most believe that the S&P 500 finishes higher, single digits, than it is today. Okay. So when you turn January 1st this year and we look at where the S&P is, they believe that the stock market will be higher at the end of the year. However, both of them believe we'll test the lows of September of last year, which means there's some pain coming. And what's really interesting to think about, and you'll remember this because you're going to pay attention to this, one of the people that I follow that we've had conversations with from the economic standpoint says that recessions typically end when something breaks. And they believe where there's a 75% chance we have a recession next year. Okay. But a 60% chance that it's going to be mild. So both firms believe a recession next year. Both firms believe that it's mild, which means it's not 08 or 09. We might be there now, who knows? But if something breaks, I said, what about Bitcoin and FTX and what's going on in the market? They said, not big enough market. Credit Suisse is a bank that had some issues. Maybe that was it, but they worked their way out of it. You had UK have some issues with their parliament, and then she left, and they put somebody else in their bonds that were going down. And most likely, we haven't even thought about whatever breaks. And he said, at some point, you're going to wake up and feel like you want to throw up because this is the worst market you've seen, and then that'll be the tipping point. So I guess what I'm saying is I'm not painting a pretty picture other than if you have a long-term focus, you're going to be okay, but there's going to be some choppy waters, we think, this next year as well.
Very cool.
Yeah.
And so if people have questions about this type of thing, or they're getting nervous as they're heading into this next market, what is the right next play?
Yeah, I mean, you can go invest online anytime you want. You can open up an account and throw your money in an account and invest online. The reason why people invest with an advisor such as our firm is the fact that they want to have somebody to talk to. So we've been communicating. We're doing things like this to put out to our clients to communicate with them. But really, diversification is key. Back to the bond comment, I think bonds swing back to where they normally are, and hopefully you can get a 4 or 5% return in your bond portfolio, have more stability. 10-year Treasury, I think, isn't going to move a lot from where it is today. It's at 3.7. It might go to 4.25 by the end of next year, but I don't think 30-year interest rates are going to be at 10% when you look at doing a house loan or something like that. So diversification is key. Dollar cost averaging always wins on when putting money in. Yep. So when you're adding money to your account, your 401k and things like that, volatility is actually okay because you're going to buy more shares on sale long term. Yep. by dollar cost averaging in the market. And then lastly, and you've heard me say this, the bottom line is what's changed? What's changed in your situation, in your own house, in your own life on why this market matters to you so much today? Mm-hmm. If you have time to let this thing ride out, just let it ride out and continue to be diversified and do the right thing with your investments. So yeah, absolutely, they should give us a call. But just keep it in perspective. Investing isn't hard if you can, tuck away the statement once in a while or look the other way when it comes, just from the standpoint of being able to weather the storm when it happens.